Saving and investing. You might have a savings account at your bank. Right now, these accounts are not paying very much interest, probably less than 1%. This means that if you left $100 in the bank for a whole year, at the end of that year, you'd have $101. Not so great. Certificates of deposit is another type of savings account at your bank. You need to give them a bigger chunk of your money and leave it in the bank for a longer period of time. Let's say $5,000 for 5 years. This type of savings account will earn you higher interest, but you must keep the money in the bank for the full term of agreement. The good thing about putting your money in the bank is that your money in the bank is guaranteed by the federal government, and you will get your money back, 100% guaranteed. The downside of having your money in the bank is that you don't earn a whole lot of interest, so very low risk and very low reward. So what's the difference between saving and investing? Generally, saving is short-term and investing is more long-term. Now there are lots of different ways you can invest your money. You can invest in land, real estate, or even invest in gold or silver. You buy it now and hold on to it and hope that the value of it goes up. Some terms to know. Liquidity. How fast you can convert an investment to cash. If you have a savings account at your bank, you can get access to your money at any time. If you own real estate, it generally takes a while to sell land, so it would be considered less liquid. Bonds. Bonds are sort of like borrowing money to a company or the government. Do you own a U.S. savings bond? That means that you borrowed money to the U.S. government. Now you have probably heard about stocks. When you buy stocks in a company, you are buying a very small fraction of ownership in the company. There are two ways you can make money on stocks. One, if you buy the stock and the value of each share goes up, then you can sell the stock and earn money. You want to buy low and sell high. Of course, if you make money on the stock, it is called capital gains, and you have to pay income tax on it. The second way you can make money on a stock is if the company declares a dividend. When the company makes money, it can share of that earnings back to the stockholders. So if you own 100 shares of the company and they declare a dividend of $1 per share, you would receive $100. When you buy stock, you select stable companies that have been around for a long time because you want a safer investment. Safer, meaning you have a less chance of losing your money. Some newer companies that haven't proven themselves are a riskier choice. Riskier means that you are not sure if the stock will go up in value or if you will even get your money back. Some more terms to know are diversification. This means to invest in different types of investments. Don't invest in only one company. If the company doesn't do well, all of your investments will go down. If you have a whole bunch of different investments and one doesn't do so well, you can still do well overall. Another is mutual funds. Most people don't study the stock market and don't have a good idea on what stock would be a good investment. If that is you, you might choose to invest in mutual funds. A mutual fund is invested in a bunch of different investments, so when you buy into one, your invest is already diversified. Generally, the lower the risk, the lower the return, and the higher the risk, the higher the return. However, if there's high risk, there's also a very high risk that you will not earn your money back or maybe even lose some. The last term to know is the rule of 72. The rule of 72 is 72 divided by your interest rate. This tells you how long it will take for you to double your money. So let's say you invest $100 at a 10% interest. If you take 72 divided by 10%, which is the interest rate, that equals 7.2. So 72 divided by 10 is 7.2 years. It will take 7.2 years to double your $100 to $200. I hope this helped improve your better understanding of the meaning of saving and investing.